Stop thinking IPOs are fair for retail investors. Seriously, if you think stock prices are determined by supply and demand, you are about to learn how the game is actually played. Here is the counterintuitive truth that Wall Street doesn't want you to know. Nasdaq just changed the rules specifically for SpaceX. Starting May 1, 2026, new rules take effect that will force ETFs tracking the Nasdaq 100 to buy SpaceX stock at any price within 15 days of trading. The minimum float requirement is gone. Fast inclusion is here. The result? $3.1 billion of forced buying from just two ETFs, QQQ and QQQM. And if insiders sell more shares, that number could jump to $23.8 billion. Not because the ETFs want to buy, because they have no choice. Let me break down exactly how Nasdaq rewrote the rules. And stay until the end for the 3 secrets that will change how you view every mega IPO from now on. I'll admit something. For years, I assumed index funds were neutral. They just track the market. They don't pick winners or losers. I was wrong. Index funds are not neutral. They are legally forced to buy whatever enters the index. And Nasdaq just changed the rules to guarantee that SpaceX enters the index fast. Today I'm going to show you exactly how this works. We're going to look at the 3 new Nasdaq rules, the math behind the forced buying, the real-world examples, Tesla, Palantir, Coinbase, and most importantly, what this means for SpaceX insiders trying to cash out. By the end, you will understand why this is the biggest gift Nasdaq has ever given to an IPO. Stay with me. Let's start with the rules. Nasdaq announced these changes on March 30th, 2026. They take effect May 1st, 2026. Rule 1. No more minimum float. Previously, a company needed at least 10% of its shares freely tradable to be eligible for the Nasdaq 100. That rule is gone. Even if SpaceX only floats 5% or 10% of its shares, they can still enter the index. Rule 2. Fast index inclusion, 15 days. Previously, a newly listed company had to wait 3 to 12 months before joining the Nasdaq 100. Now, just 15 trading days after listing. If SpaceX IPOs in June, they could be in the index by July. Rule 3. Modified market cap for low-float stocks. This is the most important rule. If a company's free float is less than 1/3 of its total shares, Nasdaq will multiply its market cap by 3 for index weighting purposes. The counterintuitive truth? The rules were designed for very large companies. Everyone knows that means SpaceX. Nasdaq is not even hiding it. They want SpaceX in their index, and they rewrote the rules to make it happen. Now, let me show you the math. Because the numbers are staggering, the ETFs. 2 ETFs directly track the Nasdaq 100 Invesco QQQ Trust, with about $376 billion in assets. Invesco QQQM, with about $147 billion in assets. Combined assets under management, $523 billion. The SpaceX weight, with a $1.75 trillion valuation and a moderate free float, SpaceX would rank in the top 10 of the Nasdaq 100 by weight. Estimated weight, about 0.6%. The forced buying 0.6% times $523 billion equals $3.1 billion. Under the old rules, forced buying would have been only $1 billion. The new rules add $2.1 billion of free liquidity for SpaceX. The counterintuitive truth? ETFs don't get to choose whether to buy. They don't get to negotiate price. They must buy shares on the open market, at whatever price sellers demand. This is not an investment decision. This is a math requirement. Now let me show you the even bigger numbers. Because honestly, $3.1 billion is just the start. So, let's talk about scenario 1. 10% free float. If SpaceX floats 10% of its shares, which is about $175 billion, the 3 times multiplier doesn't apply since the float is under 33%. But they still enter the index thanks to the eliminated minimum float rule. The estimated forced buying is still around $3 to $4 billion. Now, scenario 2, 33% free float. If SpaceX floats 1/3 of its shares, meaning insiders are selling pretty aggressively, the 3 times multiplier kicks in. Why? Well, because the 3 times rule applies when free float is less than 33%. But wait, 33% is the threshold. At exactly 33%, maybe there's no multiplier. But the point is, the more insiders sell, the more ETFs are forced to buy. Now, let's look at the maximum scenario. If the 3 times multiplier applies fully, the forced buying from QQQ and QQQM alone jumps to $15.6 billion extra. That brings total forced buying up to $23.8 billion. And here's the counterintuitive truth. The rules actually create a perverse incentive. Insiders want the float to be low, so the multiplier applies, and ETFs buy even more. The mechanism designed to help low-float stocks actually encourages insiders to keep the float low. This is not a bug, this is a feature. Now let me show you what happens when forced buying hits. Tesla in the S&P 500 back in 2020. Well, from the announcement of inclusion to the actual inclusion date, Tesla stock rose by 70%. Why? Because index funds had to buy, and honestly, everyone knew it. Frontrunners bought ahead of the forced funds. The price was artificially inflated. Take Palantir, ticker PLTR. When Palantir was added to the S&P 500, the stock jumped 14% in a single day. And with Coinbase, ticker Coin, when it was added, it jumped 24% in just one day. The pattern is, really consistent. Index inclusion creates a predictable, front-runnable buying event. The only question is, how much? The counterintuitive truth. For SpaceX, the effect could be even larger. Why? Because the new Nasdaq rules are even more aggressive than S&P's rules. And, SpaceX is the most anticipated IPO in years. The front-running could start the second the IPO is announced. Let me leave you with the 3 secrets that connect everything we just discussed. Secret number 1. Indexes are not neutral. Most investors think index funds are passive. They just track the market. But when an index changes its rules to favor a specific company, that's not passive, that's active. The neutral benchmark just picked a winner. Secret number 2. The free liquidity gift. Every dollar that ETFs are forced to spend on SpaceX is a dollar that insiders can use to cash out. This is not an accident. Nasdaq wants SpaceX to list on their exchange. To attract the biggest IPO in history, they offered a gift-guaranteed demand from $523 billion in ETFs. And that demand? It's price insensitive. ETFs don't care if the stock is expensive. They have to buy. Secret number 3. The front-run window. The 15-day window between listing and inclusion is where the money is made. Front-runners will buy shares knowing that ETFs will buy more on day 15. This creates an artificial price floor and potential upside for early investors. The only question is, who gets access to shares before the front-running starts? So, what should you actually do with this information? If you are a retail investor hoping to buy SpaceX at IPO, be careful. The IPO price might look reasonable, but by day 15, ETFs will be forced to buy. Frontrunners will push the price up before the inclusion. The price you pay at IPO could be significantly lower than the price after forced buying. Or, you could buy after the forced buying, when the artificial demand is gone. If you are an institution with access to pre-IPO shares, the 15-day window is your exit strategy. Sell into the front-running demand. The ETFs will be your buyers. This is the free liquidity that Nasdaq designed. If you are a SpaceX insider, congratulations. Nasdaq just gave you the best possible exit. Guaranteed demand. Price-insensitive buyers. Fast inclusion. The only risk? If the valuation is too astronomical, and honestly, some advisors warn it is, the forced buying might not be enough to sustain the price. The counterintuitive truth? The rules are written for the benefit of large companies and their insiders. Retail investors get the leftovers. Know the game before you play. Here's my question for you. Do you think Nasdaq's new rules are fair, or did they just rig the game for SpaceX? Drop your answer in the comments. I read every single one. Like and subscribe if you want more analysis on IPOs, index funds, and the hidden rules of the market. I'll see you in the next video.